All right. Today is Sunday, November 10th. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. I hope everybody is rested and had a great weekend and now you're ready to go. We're going to begin with this headline right here from the Wall Street Journal, of course, and it reads how Trump won the manosphere. It's those evil men in the country again, betraying all of the women. We got a sexist pig country that keeps voting against women all the time. Maybe not, though. We'll explain to you in a minute why this took place. But I love to have the paper version of the Wall Street Journal because they have the tendency of printing a certain headline, then they realize it's embarrassing and they fix it online with another headline. And online, they blame it on Barron, who connected his father to the manosphere. Look at this guy. The resemblance is crazy, right? He looks exactly as a young Donald Trump. I think he'll be president someday, probably revenge for assassinating his dad. But we can talk about that in another video, because next time, they're not going to miss. But anyways, was it really the men, just because they felt like it, caused the sway in this elections, or was it another reason that maybe impacted men more than women and other groups more than others that led to this outcome? We go back to what we've been talking about since the get-go. The disconnect between the media's narrative of, oh, this is and Wall Street, by the way, the banksters, you know the deal. They love to come out and say this is the greatest economy ever. The consumer is robust and resilient. They have money in their pockets and they're spending and everything's great. The Inflation Reduction Act, Bidenomics, inflation is gone, it's dead. The Fed says so, but we told you in reality the economy is horrific. And now even the media realizes that it was the economy, stupid. And it wasn't the perception of the economy that you folks who live in a bubble. No, we're talking about the real perception of the economy among the working class. Good Morning America says why inflation helped tip the elections toward Trump. According to experts, in this channel, we didn't need the experts. We already knew that ahead of time. The economy is horrific, and if the elections is about the economy, the reality will show up. And now, the important finding from the elections, Friday we got some macro data that says, oh, consumer confidence is surging higher. No. Consumer confidence is in the toilet in reality. And the elections is the only poll and the only economic data that I rely on. What people actually did when they went to the voting booth. And oh my God, even CNN now realizes, on elections night, before elections, they were saying, oh, Bidenomics, economy is great, why is there's disconnect in the polls with folks not believing how great the economy is? On elections night, after the fact, they revealed the reality. Take a look.
What this shows you is not votes. This shows you the darker the county, the more that county has been hit by inflation. Meaning, the darker the county, the more cost of living, energy prices, gas prices, housing prices in a lot of places have outpaced wage increases. Right? Try to find me. See the green?
Yeah, what does that mean?
That's the county where your wages have outpaced inflation. You can use a hand. You will show one hand in the more than 4,000 counties and townships in the United States. You use one hand to fill out the counties where wages have outpaced inflation.
So can I make some observations?
So I just want to come back into your comment.
Oh my goodness.
I want to come back into your comment. The darker the county, the more punishing, the more inflation has outpaced your wages, your cost of living, and just more. The fact that she's doing as well in the suburbs is a testament to the Democratic strength there. But you see in these other places, it's just, that was the headwind. And that came up. I can tell you I was on the road for 15 months, and that came up from the first trip to the last trip, even for people voting for Harris, even for people gladly and proudly voting for Harris, we're saying it still sucks when I go to the grocery store.
And again, folks, it goes back to the old saying, it's the economy, stupid. Even though that trash human being who made up that saying, this time around he says, hey, it's not about the economy this time around, right? But it is about the economy, you said it right the first time. It's basic. Are you better or worse off 4 years ago? And this time around, 64% of those who said that their economics, their finances, worse than 4 years ago, 64% went to Trump. And that was the majority of the electorate. The majority of folks said that they're worse than 4 years ago. So again, that's what the election is basically all about. You could talk about any kind of issue that you think it's more important than the economy, but it comes down to the finances. People vote based on their pocketbooks. But the CNBCs and the Wall Street Journals and those kind of types who live in a bubble, all of the feedback that they hear about the economy comes from the hedge funds and the banksters and the 1%. And guess what? If you're rich in this economy, if you're a millionaire, it's the greatest economy ever. You don't even have to produce anything. Just sit in your ass and watch the market being manipulated higher, and you'll be fine. And this is quite shocking. I mean, look at this. This is from Financial Times. Democrats fared better with the richest Americans than the poorest for the first time in decades. And that shows you right away that the Democrats abandoned the middle class, the working class. They have chosen Wall Street and the stock market over Main Street and the reality of working class. And here's the result. You wanted the votes of the rich? You got it. But the poor and the middle class, they ain't going to vote for you. And that's the majority of voters. If we look at the votes shifted Republican versus shifted Democrats, those earning over $100,000 shifted Democrat big time. Again, greatest economy ever if you're rich. If you're one of these tech workers, overpaid tech workers, cashing in $300,000, $400,000, sure, economy's great. But those earning under 50 grand and from 50 grand to 99,000, under 100,000, all shifted Republican in huge margins, the likes that we've never seen before in the history of American politics. And if we're going to tie it all in between the economy and why men voted a certain way, this is the 2020 Biden versus Trump results, and I want you to pay attention here to the categories of Latino men, Latino women, men 18 to 29, and then income under 50K, income 50K to 99K. You can see that the majority of these categories voted for Biden in 2020. Now watch what happens. If we shift Harris versus Trump, oh boy, all of a sudden, 55% of Latino men voted Trump. Men 18 to 29 went from 41% last time to Trump to 49%, the majority. You look at the income under 50K, only 44% went to Trump last time around, and this time, 50%. Now, 50K to 100K, last time around in 2020, 42% voted for Trump, the majority voted for Biden. Now, the majority, 51% voted for Trump. I rest my case. It's all about the economy, and the economy's dog shit right now. So in social media right now, a lot of folks are blaming Latinos for why we have the orange man again as president. But at the end of the day, the headline here in the Journal says that Trump's huge Latino gains put a big crack in the Democratic coalition. And why is it? Trump spoke to working-class Latinos, worried about the economy and, yes, immigration. Look at the shift in the Hispanic vote in the city of Philadelphia, for example. Again, unbelievable. Things that we've never seen before. These are huge shifts. If you're in the Democratic Party right now, you're shitting your pants. You're losing the Latino vote, which the whole point was someday Texas is going to be blue. No. Texas is becoming even more red, and it's the Latinos who are doing it. You look at the border counties in Texas-Mexico border, and look at these shifts. It's quite unbelievable. It's shocking even to me, to be honest with you. In Hidalgo County, in Maverick County, maybe we should move over there, Maverick County. Everybody's now voting Republican in the border counties, Webb County. So, I mean, there's something here that everybody missed in the media and the talking heads. But if we want to connect it again to, the manosphere thing, who do you think does the working class jobs? What do you think Latino men do? They're working all in hedge funds and Wall Street? Of course not. They're doing real jobs in the economy. They're working 2-3 jobs to pay the bills, and it's not enough because inflation wrecked the working class in this country. And that's why the Latino men vote shifted, and with it, shifted the entire elections. Men, all in all, are not doing pretty good in this economy. I mean, all we hear about is women, as if they portray this country as we oppress women and we lock them in the kitchen. This is Afghanistan all of a sudden. But women have been outpacing men in college graduation for years, and postgraduates also, for decades now. And it's specifically when it comes to young men. Look at this map right here. It shows the margin of how young women out-earn younger men in these particular counties, sometimes 100% or above. It's pretty much in every place you want to live in this country. We see women wages outpacing men. Even the CEOs, right? Women CEOs get paid more than men CEOs. But all what we heard about, I mean, I live in Nevada, which was a toss-up state, so we had a lot of ads here. And all of the ads came from Kamala Harris. Nothing about the economy, maybe one or two. Once in a while you hear something. But it was all about women. What do you think if you're a Latino man watching this working class, 2 jobs, 3 jobs, how do you think you're going to vote? One party is not talking about your issues at all. Another one, maybe you despise the orange man, but at least he's talking about your issues. And this is, to me, the most shocking one. In Texas, look at the shift here from 2020 to 2024. Latino men, 38% voted for Trump in 2020, 53% voted for Trump in 2024. Latino women, I assume working class, right? 36% voted for Trump 22, 48% voted for Trump in 24. Black men, 15% in 22, 34% in 24. So there is frustration about this economy. It's impacting men more than women. Negatively, of course. And that's what led to the shift that we've seen in these elections. Will the media now listen? Will the Wall Streeters and the talking heads listen now? That this economy is not as good as you guys been portraying. This economy has a lot of casualties. A lot of folks, working class, lower income class, getting absolutely annihilated in this economy. And that's the backbone of this country. You've ignored the plight of the common man and woman. As you've seen, working class women also shifted their votes. Are we going to see a change now? I doubt it. But here's the bad news for the working class men and women who think somehow that the orange man is going to fix it all. I think the election of Trump is the nail in the coffin in this economy. I know that the majority voted for out of frustration. Probably the majority of voters know that Trump with no Trump, it's going to go down. But at least out of frustration, I'm voting for somebody else. But we all know that this economy and this market been pretty much held up. It's a zombie economy, but it's been held up by a ton of debt, a lot of manipulation in the bond market. I think right now they got the perfect boogeyman. If you wanted to let the economy go, you can just blame it on the boogeyman. You guys thought they're going to vote for the orange man and he's going to work for the middle class and all of that. Now look at what happened. We have a recession, folks lost their jobs, and they're going to blame it on him. And by the way, the Trump policies that are coming your way, a lot of them will exacerbate that nail in the coffin. More on that in a minute, because you might have noticed right away after the elections that the market looked at the glass half full from the upcoming Trump presidency, but not the glass half empty yet. So when we look at the extreme reaction that we got, post-elections, of course, we see increasing volatility, we see the market going down. And if you look at the chart right now, the SPX daily chart, we went down to the lower bands. And then after the elections, we see a big pop higher, volatility crashes, and now we're trading from one extreme to the other in the bands. Have we seen anything like this before? We go from one extreme to the other. The answer is yes. You have to go back to 2016, the Trump elections. Heading into the elections, the market was getting hammered. After the elections, all of a sudden the market realized that, oh, he's going to cut taxes on corporations. So let's jerk off to that and shoot the market higher. Of course, the reaction that we have today is more extreme than the reaction that we got in 2016, but there are mechanical factors on why that happened, such as the proliferation of options trading, which was not as popular back in 2016. But let's debate this for a little bit, because you'll hear a lot of folks right now flip-flopping. So the Steve Leismans of the world and CNBC, all of the economists who are, the economy's great, doing better than ever before, they're going to begin to flip because they're political hacks at the end of the day. They're going to begin to flip that, oh, the economy, inflation is about to rise again because Trump and all of that. Then you see the other side, the hypocrisy from the other side. Folks who are shitting in the economy now that they got their guy in the White House, all of a sudden they're going to flip-flop and say, oh, but the economy is recovering and now we're going to do better than ever before. And all of the problems that you talked about, that all of a sudden got erased. I promise you one thing. You will never see this kind of hypocrisy here in this channel. We will always tell you the truth about the economy, regardless of who's in the White House. And we're going to hold their feet in fire. You're in power now. It's your mess. I don't care what happened before. But right now, you're going to hear a lot of, again, glass half full about what happened. A lot of folks, specifically in the retail investors crowd, will feel FOMO that, oh, maybe we have the Trump presidency. We're going to have a replica of 2016 when we see a huge surge in the market. Of course, the pop that we got this week happened algorithmically and mechanically because of the crush in volatility, and most investors did not really participate in it. The majority of the gains happened overnight in the gap higher. Now investors are beginning to chase it a little bit. And now, of course, the Wall Streeters are talking about it as it's a good thing. Why it's good for the stock market, the retail investors did not chase the post-election rally. Well, they didn't chase it because it happened overnight. They chased it Friday, they chased it Thursday after the fact. You'll see them chasing it even this week. But the question is, what if the market all of a sudden, after the algorithmic reaction, because you got to remember this, the algos are programmed, if Trump wins, you're going to buy, the Caterpillars of the world, the Mariettas of the world, the banks, the big caps. So there is an exaggeration in that kind of reaction. And then folks, of course, begin to stampede the FOMO, what already happened. And folks who are betting the other way, they begin to cover their shorts. And we see extreme reactions to the upside. But what if the market begins to look at the glass half empty side of the Trump presidency? This is really important because I know the seasonality is pretty good for the market going all the way to the end of the year, but we might be back here next week and we're talking about, why did the market go down? So it's important that we discuss the glass half full and half empty. We begin with the glass half full. The easiest one, of course, tax cuts. He's going to extend the current tax cuts. That's already priced in. I think that's the right thing. He cut taxes. The Biden administration kept those tax cuts, but he wants additional tax cuts, specifically corporate tax cuts. And again, is that a net positive or a net negative? It is a net positive for sure. And you see last time around, the impact of the tax cuts did indeed move the S&P earnings per share higher because it improves corporate margins when you're paying less taxes. Of course, at the end of the day, it depends on corporate revenues and actual costs, and inflation comes into that conversation. The consumer comes into that conversation. But the assumption right now, if everything holds the same and you introduce tax cuts for corporate balance sheets and income statements, that's a net positive. And it's especially needed right now because among the companies that reported so far, providing negative outlook for next quarter, that's increasing all of a sudden. We're more than 60%. And we know that the stock market is fully valued right now. If we look at the S&P 500 price to earnings ratio, it's pretty much at the highs of the dot-com bubble and close to being at the highs of 2021. So if we need an excuse to expand multiples even more, we can use the tax cuts as a reason to do that. What else in the glass half full side of the equation? The assumption of deregulations. And immediately, the moment Trump won, you've seen the banks exploding higher in cartoonish ways. Ridiculous. And it was an easy counter trade right off the gate. When JP Morgan was up 12%, you gotta buy puts on that in a pullback. And they're pulled back 5-6%. But the point being, the headline here reads, Goldman City soar as with Trump poised to deliver deregulations. The Basel kind of regulations that the Biden administration wanted to do, that's kaput now. That's the assumption, of course. By the way, deregulation of the banks by the Trump administration would be pretty much allowing all of the predatory lending and the banks screwing the middle class and working class. So be careful what you wish for here. But again, the assumption that the Trump administration will be friendlier to the banks, all of a sudden that's the magic wand that's going to fix these shitty lenders like Capital One. Look at this reaction. That's overreaction. And again, gave us a nice pullback, but I'm not going to fight stupidity for too long. You can run with that a little more. That, these companies have bad loans, but with the deregulations, the books will be better. And they can factor in for the bad loans and the delinquencies and all of that. So that kind of sentiment could last a little more. But the extreme reactions from a technical standpoint, of course, open opportunity for pullback trades, and then we'll see what happens. The same for Synchrony Financial, another shitty lender, which is probably going to go under since rates are still going higher. But anyways, that's a different story for now. This is the optimism. This is the glass half full. You pump Synchrony higher, you pump all of these lenders higher, the banks higher. We've seen incredible rallies. Folks, look at the technology sector, but the most incredible pops after earnings happened from these financial companies. And the third source of hope in the glass half full is infrastructure spending. Now, whether that's going to happen or not happen, the Biden administration was doing a lot of infrastructure spending too, but folks usually look at the Trump presidency as they did back in 2016 as, he's going to spend more in building roads and bridges and all of that. So immediately, folks begin to buy Martin Marietta, MLM, right? That's in white, up about 6.8% since the beginning of November. The XLI Industrials also are big. You look at the OIH, this is the Oil Services ETF. So the assumption is Trump is going to increase production of oil. That means we need more investments in infrastructure and the equipment side of energy. And the OIH has all of these companies, so it's up about 10% since the beginning of November. What about the glass half empty side of the equation, though? How about the tariffs and the trade war? And anybody who doubts that Donald Trump is going to implement tariffs, you don't understand the man. He's been talking about this since the get-go. If you want to give him credit for anything, he's been consistent in this issue, and he's not going to back down. He thinks that tariffs are a good thing, and he's been talking about this for a long, long time. Take a look.
They are ripping us like we've never been ripped before. If you look at Japan, if you look at China, where we lose $100 billion a year with China.
The fact is that you don't have free trade. We think of it as free trade, but you right now don't have free trade. And I think a lot of people are tired of watching other countries ripping off the United States. This is a great country. The enemies you can't talk to so easily. I'd make our allies pay their fair share. We're a debtor nation. Something's going to happen over the next number of years with this country, because you can't keep going on losing $200 billion, and yet we let Japan come in and dump everything right into our markets and everything. It's not free trade. If you ever go to Japan right now and try to sell something, forget about it, Oprah. Just forget about it. It's almost impossible. They don't have laws against it. They just make it impossible.
Now, tariffs are inflationary in nature. Specifically, if you already have an inflation problem, the last thing you want to do is tariffs. But to each his own, he's going to do it. I don't think he's going to back down from that. The headline here reads, companies have a playbook for tariffs under Trump. It includes... here we go. Price increases. Uh-oh. The former president has proposed a tariff of 60% on goods from China and an across-the-board tariff on imported goods. European goods will get hit to everything. And we already have. Look at inflation expectations. The 2-year U.S. break-even inflation. Forget about this, the sentiment surveys, all of that crap. In real life, inflation expectations are going higher. And for a good reason. And by the way, all of this trade war and all of that, you have to think about it in a different way, because you see the reflection right here. The trade war and the tariffs sure will be bad for certain equities, but good for others. So immediately after the election of Trump, we've seen reactions in steel, the SLX in orange right here. AA, that's Alcoa, up over 10% since the beginning of November. FCX copper also up, but it went down on the China news that the stimulus is smaller than expected. We'll talk about that in a minute. And copper is the most sensitive to China and all of that. But the XME metals, all in all, is also up nicely since November, and we expect more gains. If we have a trade war, and you're going to see the prices of steel and aluminum and copper and many other metals, even lithium, specifically lithium, if we see the prices going higher into a trade war, you're going to have a basket of stocks that will perform pretty good. What's not going to perform pretty good is the economy, stupid, because now we have to pay more with higher inflation from the tariffs. And what is that going to do to the after-tax income for everybody? According to the Peterson Institute of International Economics, everybody's going to go down, even the top 1%. But specifically, the lower and middle income folks, they will lose income, which means less spending in the economy, which means less corporate earnings, which means great stock market, right? Anyways, you look at the projected here from the National Retail Federation, the projected increase in consumer prices. And they have two scenarios, A and B. They looked at the 60% tariffs, so 70% on China, and then the 100% tariffs on China. Maybe it's going to be scenario A or B, but at the end of the day, he's going to increase tariffs, specifically on China. And you will see the prices of everything. Even with the mild scenario, the price of apparel will go higher by 12.5%. Toys, 36.3%, furniture, 6.4%, household appliances, 19.4%, footwear, 18%, travel goods, 13%. That is the equivalent in lost consumer spending power for all of that increase in inflation. So you see that consumer is losing in every scenario, in every category. Of course, the skeptics would say that, Trump doing the tax cuts, that's not going to increase inflation or widen the deficit because the tariffs will close the deficit down. The reality disagrees, though, because last time around, the tariffs did not really close the deficit. So this is the reality of what's going to happen when tariffs and the trade war intensifies. And it will. The question now becomes, what happens to the market if it begins to look at the glass half empty side, the trade war, the tariffs, not the tax cuts? What happens to the stock market? You got to remember, certain side of the stock market, like the metals, the steel, the aluminum, will do pretty good. And maybe Chinese stocks too. I know they went down because the 1.4 trillion package is smaller than expectations. But at the end of the day, with the trade war, the Chinese government has no other choice but to continue to stimulate. They don't want to overpromise right now. This is a communist government, at least on paper. So when they issue stimulus, it looks bad for them. So they want to tame it as much as they can. But they cannot escape reality. They're going to have to issue more and more and more stimulus. And that could be good for Chinese equities. When we have the tariffs and the trade war happening, do we have a front loading of demand in shipping and freight? The answer is yes. So we see all of these freight companies exploding higher after the elections. From the trucking companies to the railroads, all of them shooting up significantly higher because folks assume that we're going to see more demand on shipping right now before we see the implementation of tariffs. But we say this is the glass half empty because it will impact the majority of the market negatively. Why? Because we have a market that is heavily weighted in a handful of names. A lot of these names happen to be semiconductor names. You know the name I'm talking about, right? NVIDIA. And last time around, the trade war was most negative to the semiconductors. So if the trade war hits semiconductors, because he's going to be more aggressive in China, ban exports of chips to China or advanced chips to China. What happens if NVIDIA suffers as a result of that? It's going to impact the entirety of the S&P. It doesn't matter if the trucks or the railroads or the oil stocks or the Martin Marietas of the world going higher. If NVIDIA goes down, it drags everything down with it. So, if you look at the NVIDIA here in white and the SMH and the candlesticks, you can see the gap in performance since October. NVIDIA up 26%, the SMH, the semiconductor ETF, with NVIDIA as the highest weighting, is only up about 5.5%. So what is the disconnect here? Plug in AMD. AMD is down 7% in the same period of time. Now, you might say, but yeah, AMD is a shitty company, NVIDIA is a better company, yada, yada, yada. The truth is, AMD showed impressive results in growth in data centers in the last quarter. Their guidance was not good, but they weren't like they're losing money. And oh, by the way, let's zoom out a little more. Look at the correlation between SMH, AMD, and NVIDIA. They all trade together, except recently, when AMD went down, NVIDIA went higher. So who's telling the truth here? Is AMD super undervalued at this point? If we assume that NVIDIA is right and we have a massive catch-up trade here in AMD? Or is the reaction by AMD the reality? And NVIDIA is just trading on its own here because folks are buying it or they're having FOMO or playing some cute option market games. And then when the name reports earnings, we see it catching up with AMD. That would be disastrous because this is the most important stock in the market right now. We go back to the glass half full and half empty. What do we have in the glass half empty perspective? The deficit war with the Fed. We talked about this in details in the last video we made during the week, the upcoming war between Powell and Trump. Now, the chairman of the Federal Reserve, he's, of course, arrogant, and he's a nasty man, by the way, in reality. I mean, they portray him as this old, tiny guy who's so sweet, but he's a nasty man. We've heard a little bit of his true personality when he said, shut the door, right? Imagine how he talks about the lower and middle income working class in this country when he's talking to his buddies in Wall Street. This man is a criminal, and he chose Wall Street over the working class of this country. And now he says I'm above the law. The president cannot fire me. And this is setting the stage for, I'm going to grab a ton of popcorn here. I cannot wait for this war to happen. Forget about Israel-Iran or Russia-Ukraine. I want to see this war right here. Because you have a president who's going to do tariffs and trade wars and tax cuts. In other words, he's going to expand the deficit like mad. And you have a Federal Reserve chairman who right now says, oh, when that happened, maybe I'm going to consider and react to it. So he wants to be late again to the game. But right now, he's concentrating on his own legacy of, oh, I'm going to drop inflation down and avoid a recession by cutting rates, even though the bond market is telling me out loud that I'm making a mistake. At some point, though, when we see the tariffs impacting the economy negatively and we see higher inflation, he's going to be forced to pause, if not even hike rates again. And the Federal Reserve at that point would have a great excuse to blame it all on the boogeyman. Oh, we wanted to cut rates and we were on the path of a soft landing. But then came the orange boogeyman that you Latinos voted for. And now we got to have a hard landing instead. The Federal Reserve demon from Minneapolis, Kashkari, says that Trump tariffs could reheat inflation if they provoke global trade tit for tat. And they will, because the Chinese are just not going to sit there and take it. They're going to fight back. We made a video before, 1929 Lessons Learned, when we did the anniversary. And we talked about how the tariffs back then collapsed the global economy. And they'll do it again this time around because we already have an inflation problem. We don't need to add more gas to the fire. But again, the president or president-elect right now is determined. And I have no reason in my mind here to doubt that he's going to do the tariffs. He's going to try to cut taxes. He has the majority, the House, the Senate. He can do whatever the hell he wants. That's going to increase the deficit. That's going to cause rates to go higher, bond yields to go higher. The Fed ability to continue to cut rates will be diminished. At some point, they're going to face the question of raising rates again. That's what the bond market is saying, folks. Okay, put two and two together. What happens to all of the loan delinquencies that we have right now? Like the auto loan delinquencies. Is that going to get better or worse? The answer is easy. It's going to get worse because the consumer now has to pay more for the tariffs. How do you think that's going to bode for the economy? Once again, the nail in the coffin. And the last element of the glass half empty, debt maturities. If we're talking about, we tie it all together. Trade war leads to, and tax cuts lead to higher deficit and higher rates. and you're going to face more and more debt maturities, specifically in the junk side of the equation. Okay, so junk bonds in 24, here in Europe, we will see more and more maturities, 25, 26, 27, all the way to 28. If rates are not down, this is going to be a disaster. Now, what kind of grade? Again, that's really important. What kind of grade of maturities we're about to see increasing? It ain't the investment grade. It's going to be the speculative grade, the highest at risk, that desperately needs lower rates, not higher. Then you got commercial real estate. In 25, that's of course under a lot of stress. About $1 trillion in maturities. 2026, over $1.1 trillion. 27, $1.2 trillion. If rates are not down, folks, that's the recipe for a systemic risk event. Now let's segue and talk about the market a little bit and then wrap it up. We're going to have a combined coverage today. We're not going to do a lot of the regular coverage that we do. We're just going to cut the chase here. In the hierarchy of events in this upcoming week, this is really important for us to understand. Number one would be the seasonality. And the seasonality is positive to the stock market. In order to pull the market down or reverse the gains that we've seen this week, you're going to need to change the hierarchy of events. The seasonality has to go way down. Because right now, we enter with the seasonality and the FOMO of the traders and all of that. That's net positive. But number two, that's another possibility of changing the hierarchy. Number two, we have the Fed policy, specifically the CPI. If we see the CPI moving higher in a big way, in changing trend kind of way, which I doubt it for this reading, but who knows? If that happens, it could take over the seasonality. And now we have to look at the glass half empty with the Trump presidency. That, oh, wait a minute, we already have a CPI problem, and this guy's going to add more tariffs, a more deficit on top of it. All of a sudden, forget about the seasonality. But that is, of course, a big if. And number three, we have the technicals. We'll talk about that in a minute in details because that's going to be important when we talk about the technicals. But number four, the policy risk. And the policy risk, again, has to be ignited somehow. Either the market just by nature begins to look at the half-empty side of the equation or the CPI prompts it to do so. But you need to change the hierarchy of events where seasonality goes way down in order to pull the market down in a significant way. But let's talk about technicals here because a lot of folks, when we talk about technicals, they say, oh, candlesticks, bear flag, bull flag. No. We're talking about the indicators and what they move. See, folks talk about the market, but in reality, we have three markets. We have different indicators that move different classes of assets. We have the dollar, bond yields, and the VIX volatility. So the dollar moves commodities, metals, gold, silver, oil, chemicals, fertilizers, emerging markets, multinationals, and solar. And we've seen a little bit of a divide here based on the elections. So despite the fact that the dollar goes higher, we see, for example, steel and aluminum going higher along with the dollar. But we see solar companies because, oh, the Trump presidency will be bad for solar and green energy. That's the assumption, of course. Or the tariffs will be bad for solar. So we see solar going down. But at the end of the day, once the election digestions go out of the window, and it will, we're going to go back to the same algorithmic reaction. That if the dollar goes down, good for these assets. Dollar goes up, not so good for these assets. And if I look at the chart of the dollar, again, this is the daily chart. We have a tension pattern. It looks that we've exhausted the bullish momentum. I don't know how high can we go here before a meaningful pullback. So I'm going to stick to my guns here and say that the dollar is probably going to pull back and maybe the CPI will be a catalyst for that. And if it does, it'll probably be good for a lot of the metals that we talked about. But just to be on the safe side, you probably want your exposure to have double tailwinds. Not just dependency on the dollar going down, but also a net tailwind by the tariffs and the Trump policies. So we go back to copper, more sensitive to China. Up to you if you want to go copper, but steel, aluminum, the XME, those are outperforming. And I think that with the tariffs, and especially if the dollar heads down, now you're going to have double tailwinds for these guys to go higher. What happens in the yield side of the equation? Bond yields. Of course, bond yields going higher, not good for these names that you see on the screen right now. Bond yields go down, better for these names. That's simplification, of course, because especially when yields go down, we have to add the context. Are we going down because good reasons, such as inflation is going down and the Fed is cutting rates? That's good for risk-on assets in the names that you see right here. We're talking about home builders, biotech, profitless companies, the small caps, the retailers. But if bond yields go down for the wrong reasons, as in recession, it's not good for these names. But it's good for the defensive side, aka risk-off side of yield sensitivity. And that is in the dividend-paying names, the defensive names, the real estate names, utilities, those kind of staples that pay higher dividend are the ones that outperform. So when I look at the weekly chart for the 30-year bond yield, I see maybe the possibility of a topping candle here. Who knows how the CPI is going to do, but right now, from a technical perspective alone, it looks to me that yields are ready to pull back. If they pull back, now we have to debate the context. Good reasons, bad reasons. And some folks would say it's going to be for the good reasons, so I got to go with the IWM. I got to go with the profitless companies. Others would say, look, if they go down for the good reasons or the bad reasons, doesn't matter. It's going to be good for the utilities. It's going to be good for the dividend-paying names. So I'm just going to stick with something that's going to work in either scenario. If you go down, that's all I need to hear. Up to you again, but let's show you something here. The IWM usually correlates, IWM here in orange, usually correlates with the TLT. That's bond pricing. We have an inverse relationship. When bond prices go higher, yields go down. When bond prices go down, yields go higher. Now we see sort of a divergence where we see bonds going down, the prices of bonds in white going down, but we see the IWM in orange heading higher. Who's telling the truth here? Are we about to see a rally in the TLT as a confirmation of the pop and perhaps more gains to come in the IWM? Or is the TLT telling the truth? It's going to head down even more because of the CPI, whatever catalyst, and pull down the IWM with it. And the rally's a trap. You got to continue to monitor this relationship throughout the week. Here's another illustration for you. SoFi. A lot of you own SoFi. I get questions about it all the time. It pretty much mimics the IWM. So it does better when the IWM is rallying higher. But it has a great correlation with the TLT too. When bond prices go higher, yields go down. And a name like SoFi, which is not producing a lot of profits right now, does a lot better. Now we see a divergence. Bonds are going down, TLT, but SoFi is going higher. It ain't just SoFi, by the way. It's a lot of these profitless names, the small caps, the regional banks are all doing the same thing. So it's up to you. You want to stick with these guys? You think that the TLT is going to catch up with it and yields will go down? Go for it. But maybe you want to go the other route, which is, hey, let me stick with the defensives. They work either way so long as yields go down. I don't like the ETFs, to be honest with you, except in steel, the SLX, the one that I own. I've been owning for a long time because I don't want to put my eggs in one basket of US Steel or Nucor or whatever. And the XLV, if you're buying healthcare, you don't want to put your eggs in one basket of one pharmaceutical name that could go up or go down. You want to buy the ETF. But besides that, I'm not a fan of the ETFs, so I think the IYR real estate has a lot of commercial real estate too. So we cannot assume that it is defensive, but the market right now assumes it is because the highest weighted names in that ETF are the old school dividend paying names, safer kind of exposure to real estate. Among them is the ticker PSA Public Storage. You look at this chart, it played out bearish momentum, now it's about to shift to bullish momentum. All I need to see is yields going down, and a dividend paying name like this will go higher. Another name would be Procter & Gamble. We look at the pop that we got just before, just about thinking about a pullback in yields. And by the way, we spotted this trade right before it happened in the stream. Take a look. Anyways, so the XLPSC summer opportunities, I talked about Procter & Gamble here, was way oversold yesterday, so it deserves to rebound, and now it gave you a little bit of sell-off here, as we've seen back right here when it rebounded, and now here. So I see an opportunity in Procter & Gamble, so I'm going to go here and trade Procter today. I'm going to go with the call. 165 is not bad on its own. 170 is too far, so I'll probably do 165, and then later on sell the 175 if it indeed moves higher. But probably 165 will be my entry. So again, when we look at the yield sensitivity side of the equation, if you think, and again, CPI could be a surprise and push yields higher again, but if you think based on the weekly closing that we got in the 30-year bond yield, that we're going to have a pullback in yields, that'll probably be good for the majority of these names that you see right here. What about the third technical indicator, the VIX, and what it moves? The VIX, volatility, hedging, it impacts the index level, the SPY, the SPX, the Qs, the NASDAQ. And of course, with that impacts the highest weighted names, the big cap technology stocks, Apple, Nvidia specifically. When we see volatility going down, these names benefit the most. So how do we see the Qs right now? Looking at the hourly chart, you can see the bullish momentum played out in the hourly. We see these rising wedges showing up, but momentum is only now beginning to curl down. If you look at the MACD indicator, it's only now beginning to turn into bearish, but we're not seeing a meaningful pullback yet. The RSI is way too hot. So if you put 2 and 2 together, at least we have a period of cooling off, if not a pullback in these technology names. Then you look at the weekly chart for the Qs. We talked about this rising wedge pattern that we see, or you can argue it's a bear flag. And this is why a lot of traders, myself included, pretty much 99% of traders, when that rising wedge was broken to the downside, took some short trades, only to get slapped with a big green candle right after the elections. And now folks are beginning to shift. Oh, you know what? They're just going to push it higher. The Trump administration is going to be the same as the Biden administration. I'm going to capitulate and buy here and chase. To each his own, because if you look at the weekly chart for the NASDAQ futures, if we stall here, we also got the risk of a double top. Then you look at individual charts like Microsoft, this is the daily chart. The line in red is the 100 days moving average. We're stalling right now. We can't assume that the chart is done. But if we have another down day, then switch to the line chart, and wouldn't it be sort of a topping head and shoulder pattern out of a rejection of the 100 days moving average? You look at Apple, it's flirting with the 50 in blue, it's above the 100 in red, but it's not looking good right now. All of these names went higher after the elections. Apple stalled, and the earnings were shit, given the evaluation of the stock right now. So if we see a pullback from here, you can switch to a line chart, and maybe we're going to be forming a topping head and shoulder here too. Now we have other big cap technology stock charts that look pretty good. Among them, of course, Nvidia, Google, and Amazon. Google was the best earnings. Amazon, the cost is going crazy, but the results that we had were okay. We're better than Apple, for example. But at the same time, we talked about this in Friday's session. With the collapse in volatility, with the VIX going down, the IV ranks, meaning the implied volatility for individual stocks, is way too low. In some names like Amazon, we see the lowest implied volatility in a year time frame. What does that mean? It means that the puts on these names are really cheap. So you gotta take a shot on playing a pullback. Easiest way we can do that, cheapest way and safest way, because there's no guarantee. But I gotta exploit the implied volatility here. We've done, for next week, we've done some butterfly puts as lottos for Amazon, Microsoft, AMD, and Nvidia. Butterflies offer exposure to the downside, but at a lower cost. So if you're not sure in the timing of a pullback, but you want to take a shot because the implied volatility is way too low, this is one way to do it. And after the discussion that we got about yields and the dollar and all of that, my strategy before the end of the week, I doubled down on DraftKings, the 40 calls lotto. We'll talk about that in a second. But also bought shares from PSA Public Storage. Let's see how this one's going to work out. I think if yields go down, we might go higher here. And Duke Energy reported earnings, went down, then found a footing and moved higher. And if yields go down, I think that a dividend-paying name like Duke, it's been an excellent performer, by the way, pays high dividend. I think that would be an opportunity, but just in case, it's not out of the woods yet as a chart, as you can see. Just in case, you want to set the stop loss at 110. If it goes below 110, forget about it. It's going to head further down south. And again, since we're not doing the usual show that we do with all of the information, let's add more color to what we just talked about by revisiting the morning brief I produced on Friday. And again, I talk about the Dixie market, the bond yields market, and the VIX market. There is no such thing as a unified market anymore. It's a robotic market. It's all about the algorithms. So in the dollar market, I said a rebound today is causing a small cap in these names. We're talking about, of course, the metals and all of the names that are sensitive to the dollar. I'm sticking to my gun that they should move higher as the dollar resumes pulling back. Some of these names also have another tailwind from the tariffs. So now you know that I favor maybe steel, aluminum over other names that don't have the double tailwind. In bond yields, I'm not seeing a ton of clarity in bond yields right now. Technically, this is in the morning, by the way. By the end of the day, we got more clarity. They're supposed to pull back too, but we have yet to see a meaningful pullback as we have seen in the dollar recently. So my exposure is very small by betting on a pullback against the IWM and a rebound in the TLT. The IWM should pull back under high yields or lower yields under recession reasons. TLT should move up if yields pull back. So I think I have a balanced exposure here. TLT was up about 1.25% in Friday's session, and the IWM was also up about 0.75%. So I think if I have one and have one against the other, I have sort of a balanced exposure here based on yields. And if they go down for the wrong reasons, both of them win. TLT goes higher, IWM goes down. Then when it comes to the VIX market, unless you think the VIX can flush down to zero, it's way oversold right now in a short amount of time, and it should rebound a bit, leading to a pullback in the indices and big cap tech. Now, we didn't see a pullback in the indices because other names were going higher, the assumption of the industrials and the banks and all of that. But then you look at the big caps on Friday in the heat map, Amazon was down, Meta down, Google down, Apple down, Nvidia down, Microsoft down. So we've seen a little bit of a pullback here because the volatility is so suppressed. And these names move based on volatility. But then you have the dollar-sensitive side and the bond yield-sensitive side did pretty good. So we've seen the indices actually moving higher. But I must say the reaction of the market on Friday, the SPX 6000, then you see selling right away. I don't know about that. It just didn't look good to me. Anyhow, On Friday, we looked at some day trading opportunities. Some of them played out. Some of them maybe they're going to play out this week. So we look at match oversold with a gap down, but you need to see a reversal first. You need to see some buying with higher volume in the intraday charts to follow that, because it could be a falling knife situation. Didn't work out on Friday. Maybe Monday, Tuesday this week, we'll see a bit of a rebound in Match.com. That's going to produce a trade to the long side. Then DraftKings, this was really stunning as a reaction. Since the stock reversed all of the losses from the post-market session yesterday, this is from Friday, of course, so we're talking about Thursday in the post-market. We will likely see more buying, so I want to double down on DraftKings calls. We're talking about a lotto that we bought in DraftKings before the report came out, the 40-45 calls, and we hedged it just in case with a weekly put options. We'll look at it in a second, but let's start, since we're looking at this here, the lottos, let's look at Airbnb. So we expected Airbnb to go down, and we bought the 140 puts calendar spread by next week, selling this week, and the trade lost because Airbnb blew through the 140 puts. So here we got the direction right, but the strikes not so good. It should have been the 135. Now, a lot of you say, what if I exercise the 140 puts and then leave the other 140 for next week going? And that's going to balance the exposure. Look, you're taking a lot of risk here. Because this is being cued with a trade that had one objective, which is entering at the cheapest way possible as a lotto. And if it works out big, as we've seen in the Intel trade, for example. But in trades like this, when we use calendar spreads, and then the results blow through your strikes, you don't want to be cute with it. It just didn't work out. It was a lotto and didn't work out. If you try to fix it and play with it, what happens is you could exercise the 140 puts. Now you got to buy Airbnb at 140, and you have the 140 short for next week. What if Airbnb rebounds closer to 140, but not quite above? Now you're losing in both. So you don't want to be cute with it. How do we avoid this kind of situation in later lotto plays? Well, you can use any other spread besides calendar. It's just going to cost you more. And the goal here from the lotto is spend as little as possible to make as much as possible. But let's go back to DraftKings here, because this was a really interesting reaction. Initially, the stock went down by 20%, and then it rebounded from the lows to the highs by over 30%. And in Friday's session alone, we've seen a little bit of selling the pop that was happening in the pre-market session, and it gave you a nice entry point. From that point, the stock went higher by over 8.5%. Extreme volatility in the individual name. So it was a good day trade. You want to keep it like I did, I'll keep it. See what happens, because I think this is a degenerate gambling nation anyways. And I don't see a reason why gambling on sports should slow down right now. Problem is the company has to spend more because they have a lot of competitors. And until they have their market share, profitability will be an issue. Then we talked about DJT Trump, and I said end of the week, options expiration, and a falling wedge pattern all make a good recipe to enter a rebound day trade today. So you look at the 4 hours chart that I gave you. This is the continuous chart. You see the falling wedge? So ironically, they bought Caterpillar and Martin Marietta because, Trump is going to be good for all of these names. But somehow they sold his company, which is supposed to benefit the most. Anyways, 25.5 was support, so it was at least worth taking a shot here for a day trade. Here's the update for you. DJT was up over 15% on Friday. And by the way, the elections trade that we got, which is you sell the 25 puts, you sell the 70 calls. November 8th, we got $650 a pop. You sell 100 of those, that's an easy $65K in the pocket. Was there a risk from this trade? Of course there was. Had he lost, I think the stock would have went down way below 25. But we are in the risk business after all, folks. If you don't like risk, you got to find another business. Then we talked about Supermicro, the trashiest company of them all. And basically here, this is the chart that I gave you. If it closes below 24.82, you probably want to take a short on it. As a day trade, if it closes above 27 from an hourly time frame, you probably want to buy it because it's going to rebound more. Here's the update for you. Flushed through 24.82 and gave us about 5% worth of gains from that point on. It might head further to the downside here because it looks like a bear flag to me, but you can also argue it's sort of a cup and handle. We'll see what happens. But Supermicro is in deep, deep trouble right now. And again, folks, we're not going to do the charts tonight because we've done most of them. But we have to look at BTC, weekly chart. We have a breakout above the resistance line. We have a confirmation in the MACD and the RSI. Sure, we're above the Bollinger Bands in the weekly. That's going to stall things a little bit. But we're not overbought in the RSI. We're not overbought in the MACD. So I think we can see more gains in Bitcoin. Because when I think about, okay, what about the headwinds right now? Headwinds for the tax cuts optimism could be tariffs and the trade war. headwinds against Bitcoin right now? I mean, I'm thinking about it. I'm not finding any, because we can run with this optimism until proven otherwise. Until it's proven that the Trump administration was just jerking off these crypto bros for votes, and they're not going to do anything about regulations or adopting Bitcoin or any source of optimism that led these shares higher. At the end of the day, these are tulips. If there's more demand, they go higher. So right now, there's more demand, and there's no reason for you to sell. So I think that the upside here is intact, even though it might face a little bit of a slowdown now that we're gapping above the upper bands. And then we have ETH. A lot of you ask, can I use ETH as a catch-up trade with BTC? My preference is BTC, but ETH, Ethereum, is poor man's BTC right now. And again, tulips, more demand, more folks betting that, hey, ETH is a catch-up trade with BTC, then it goes higher. So that's okay too. I see very little headwinds for cryptos right now, so it is a safer Trump presidency kind of bet, at least for now. And the last one is Tesla, of course. Is it too hot right now? Look, once it pops after the elections, I said, don't short it right now. You want to short or pick pullback trades on Capital One and Synchrony and all of those. But Tesla, leave alone for a little bit, because it's not extremely overbought yet. And it went higher again Thursday and Friday. Is it too hot right now? Yes, it is, but the implied volatility in Tesla is way higher than the classic names like the Metas and the Apples and the AMDs of the world. So I don't see the incentive here of playing a pullback trade in Tesla versus the big caps. So for me, I'm going to leave it alone here. And if it pulls back, if it breaks any technicals in a massive way, then we'll talk about it. But for now, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? Nothing. Happy Veterans Day. Bond market is going to be closed. Stock market will be gone. Then Tuesday, November 12th, we have the NFIB Small Business Optimism Index. Then we have a bunch of Fed zombies from Christopher Waller, Thomas Barkin, and Patrick Harker from Philly Speaking. On Wednesday the 13th, perhaps the most important day from a macro perspective, we have the CPI. And after the CPI comes another batch of Fed zombies from New York, from Dallas, from St. Louis, from Kansas City. Whatever they say, who cares? They're not in charge. The bond market at least says that. Then Thursday, November 14th, we have initial jobless claims, the PPI, which is important. Then we have the big zombie. Once again, Powell speaking. After that comes New York Fed zombie Williams. And we conclude with Friday, November 15th. Options expiration will be also important, but the import price index, that we have the Empire State Manufacturing Survey, retail sales, really important, and then that comes on top of industrial production, capacity utilization, and business inventories. We have yet another round of speech by Fed Zombie from New York. Now with that, folks, we have reached the conclusion of this video. I hope you found it informative and helpful, and if you did, return the favor by pressing the like button, leaving us a nice comment in the section below. And better yet, consider joining us as a member, Maverick member, here on YouTube or Patreon. All of the links in the description. You can access the daily show and many other benefits. But this is all I got for you for now. Thank you for listening. Thank you for watching. I'll be talking to you again tomorrow. Good night.
I have never been more vulnerable financially than I am right now.
Mr. Getty, with all due respect, nobody has ever been richer than you are at this moment.
I have no money to spare.
What would it take? I mean, what would it take for you to feel secure?
More.